A business can open a current account which allows money to be paid in and enables the business to pay money out of its account. It usually pays a very low rate of interest or none at all, so it's not a good place to keep savings or large amounts of money. When you have an account with a bank, you have a responsibility to make sure you don't spend more than you have in the account. If you need to spend more for a short period of time, you can ask the bank for what's known as an overdraft. An overdraft allows you to continue spending even when you have no more money in your bank account. The maximum amount you can borrow on an overdraft will always be agreed and authorised with the bank in advance, and the bank will usually charge for a service and do some checks to confirm that you'll be able to repay the overdraft. They can refuse to authorise the overdraft if they think you'll not be able to repay the money. The bank has the right also to ask for the repayment at any time of the overdraft, and they can charge extra fees and higher rates of interest for unauthorised overdrafts. A savings account is where a business can keep any extra money or any surplus funds. A saving account will usually pay higher interest than a current account, and money can be moved from the current account to the savings account so that the business receives better rates of interest on any surplus funds. The Bank of Ireland is the central bank for Ireland, and the Bank of England is the central bank for UK. The European Central Bank is the central bank for the Eurozone, and the Federal Reserve is the central bank for the USA. There are different types of financial institutes such as banks, credit unions and building societies. Credit unions are not-for-profit financial institutes whose earnings are paid back to the members in forms of higher saving rates and lower loan rates. Banks are for-profit and their declared earnings are paid to stockholders only. Banks are normally companies that are listed on a stock market and therefore owned by and run for their shareholders. Building societies, on the other hand, do not have shareholders. As a result, they don't have to pay dividends to shareholders. Building societies claim that they have historically offered higher rates of interest to savers and cheaper mortgages.